Hi, I'm Max Kieser. This is the Kieser Report. I'm at the Kilkenomics Festival in Kilkenny, Ireland, and we're about to speak with Constantin Gurdiev. He is the adjunct lecturer in finance with Trinity College Dublin and holds a number of other senior research positions with international companies and organizers. He was also mentioned in today's Irish Times as one of the new breed of economic rock stars. Constantin, welcome to the Kieser Report.
Thank you, Max. Good to be here.
All right. Let's talk about this Anglo-Irish deal. This is really the talk of the conference so far. So give us some more background on this and some of the numbers and what's going forward.
Well, the background is really the Anglo-Irish bank epitomizes the destruction of the proper banking, conservative banking system around the world. It's probably the most reckless lender that we had in advanced economies during the latest boom, which predated the current crisis. It was the bank which was known as the parking lot bank, because that's the amount of time it took them to approve multi-million euro loan. By the time the salesperson leaves the client, the loan would be approved by the time the salesperson gets into the car.
Let me just cut in here. How did all the risk measures get abandoned? How did that, what was their technique there? How did they simply not be able to apply any risk analysis whatsoever?
Well, like the rest of the banks, they didn't have to do much of the risk analysis because liquidity or funding was very cheap. So as a result of it, whatever you lose in the market, you can make back in terms of the higher margins, in terms of the appreciation on the asset base, which is a typical, classical, if you want, asset bubble. So in some ways, if you think about it, not just Anglo-Irish Bank, they were just more extreme case, but the entire banking system in Europe and in the United States operated like kind of like a fire engine. It was hoovering out the cheap liquidity and then spreading it in a very kind of indiscriminate way across the economy in the hope that some loans will pay back and some loans will go up.
Okay,
really
but that cheap money goes out there to feed speculation in real estate, and that real estate is used as collateral to perpetuate more loans. And so this is the ecosystem, if you will, of how things got completely out of hand because it became a self-fulfilling prophecy. As long as they kept making these cheap loans, the asset prices had to go up until such time as you had a classic blow-off.
Exactly, and the blow-off was also preconditioned by the fact that there were systems, regulatory systems and supervisory systems, both in Europe and in particular in Ireland, but also in the United States, which have diverted the efforts, or if you want, the pressure, which is building up in the system itself by creation of those artificial assets and artificial, if you want, increases in asset valuations, and also the, if you want, mispricing of liabilities risks and the maturity risks and other risks within the system. All of that was diverted by the regulatory system into, if you want, kind of concentrated allocation of the risk into one particular class of sub-assets. In the case of the United States, that was the class of, for example, the derivative instruments. In the case of Ireland, it was the class of assets which related to the property development and property investment and things like that. So not only the risk was growing on the books, on the balance sheets of the banks, and it was unchecked and unpriced, but it was also diverted. What we're seeing in Greece today right now, in part, is an outcome of the poor regulatory environment for the global banking system, which has treated the government bonds of insolvent governments, and we knew that Greece was insolvent for a decade plus, without discovering what we have learned since then about the deeper rates of insolvency, such as the Goldman Sachs deals that they have done to hide parts of their deficits and parts of their debt as well. But even apart from that, we knew that it was deeply insolvent. All you need to look is a current account. Greece has not been solvent in the last 20 years for more than just 1 year probably out of it. Ireland, by the way, in the last 10 years has only been solvent for 1 year in terms of the current account surpluses. And this is what was going on. The governments were continuously using the banking system to borrow from the markets through the banks as well, and as a result of it, they encouraged the banks to accumulate the liabilities of the state on their asset side. So the risk not only was rising and was unpriced, but it also got compounded by the fact that that risk was placed into, if you want, the box of capital. It was treated as if there is no risk at the same time as the risk was rising.
Okay, it sounds to me as if you could buy insurance on car accidents, let's say it's a Formula One high-speed car race, and you're buying insurance on a driver, but you're dividing up that insurance into the racing around the track, approaching the wall, getting closer to the wall, and then actually crashing into the wall. And then pricing each one of these differently, and then saying the actual crash into the wall itself, where the actual crash happens, this, in fact, we're not even going to count in the overall matrix of risk. And as a matter of fact, we're just going to ignore that bit, and we're going to trade the other bits approaching the crash separately.
Exactly. That's exactly what was happening in kind of a context of what we call black swan events. Very much extreme events at the tail of the probability
So they
distribution.
force all the risk into extreme events that they
Exactly.
say statistically can't happen.
That's right.
And they price everything else as if there's not going to be an extreme event, which keeps capital cheap, which keeps asset pricing rises.
Well, what's
rising.
happening in the regulatory/financial system around the world is that, in effect, we were playing Russian roulette, and after every round, we were loading new bullets into the barrel. So sooner or later, we've had the entire barrel loaded. There was no the probability of blowing your brains out in this current environment was 100% by the end of the game, and this is exactly what happened.
Well, this is important to note, that the chances of this catastrophe happening were 100%.
Oh, absolutely true. The difficulty, of course, it's different from knowing ex post, after the fact, that it had to happen at 100% probability, and knowing at the time, because the game was so big, and the game was moving so fast that the banks, like Anglo-Irish banks, were moving very fast up the ranks. Remember that back in 2006, if I believe correctly, the Davos summit in Switzerland, the World Economic Forum summit, actually voted Anglo-Irish Bank as the best bank in the world. And all of that was predicated solely on one line of the profitability.
Okay, when you say they're moving up the ranks, you're talking about they're moving up the ranks in terms of their ability to lay off these bad derivative bets on the global market at exchange rates and derivative rates and rates of exchange that are feeding into their bottom line, because their cost of capital is essentially negative, isn't it?
That's right.
First of all, explain this a little bit, because people don't understand this. I mention this all the time, and people are confused by this, because they're used to a credit card at 16% or 17%. And I say, these big banks, their cost of capital is less than zero. Explain that.
Well, in many cases, it depends on the timing. Right now, they're facing less than zero costs because they're getting subsidized capital injections from the governments, and they can go and use these capital injections to, if you want, borrow from the central banks at cheaper rates. So as a result of it, we can take the Irish banking situation right now. The Irish banks, in the last 3 months, have received a sizable injection of capital in form of the government promissory notes and government bonds. What they did with those bonds is that they took those government bonds, they put them on their balance sheet, then they went to the repo window, to the repurchase window at the ECB. They put them as a collateral, borrowed from ECB at 1.5% interest rate, and then bought more government bonds in the markets. So as a result of that, in August, September, right after it was done on July 30th when the injection of capital went into the Irish banks, in August, September, the Irish banks, two Irish largest banks, bought more than 3 billion worth of the government bonds of Ireland. And as a result of it, government bonds, Irish government bonds, went up in price. The government turned around and immediately started presenting that as the case of stabilization, that its policies are working, that everything is coming handy and all the yields are declining on the bonds. And the whole Ponzi scheme continues rolling over, both in terms of the reputational knock-on effect on the government that it claims to be, and the banks pretending that they're healthy, and the government in return pretending that the banks are healthy, because that helps them to pretend that they are themselves healthy.
Isn't this a form of propaganda?
Of course it is a form of propaganda.
So it's price propaganda. Now, people associate propaganda with political propaganda, with scapegoating, ethnic groups or religious groups, and or propaganda in terms of jingoism and patriotism. But this is a different form of propaganda. It's a financial propaganda where if the government and the banks colluding together can create the illusion of an uptrend, that then they can come out and say that things are getting quote-unquote better, but at the same time forcing through more draconian austerity measures, right?
European governments, through the systems of corporatism that have existed here for decades, this is the governance mode in Europe of the economic policy and politics as well, corporatism. Governance by consensus of interest groups. And
how is corporatism different than fascism? Because people say fascism, classic connection between...
I would be controversial here, and I always said that there is no difference until you come to the point of the differentiation of national dimension or nationalist dimension. The European corporatism today doesn't have the nationalist dimension. It is more benign, but economically, from an economic point of view, the system of organization is exactly identically the same. Ireland has been ruled for the last 20 years by social partnership. Social partnership includes government on one side of the table. On the other side of the table, there are trade unions. There are social pillar, what we call, in other words, environmental groups, the groups which are trying to combat poverty, and some of them actually have noble, if you want, objectives as well. And then on the other side, there is a big organization which unites all large businesses in this country called IBEC. And they sit down for years and sort out the entire economic pie, even though despite the fact that majority of them actually contribute very little to that economic pie. Most of the Irish economy is driven outside of that table, and it is decided outside of that table. It's decided by the exporters, it's decided by multinational corporations, it's decided by foreign investors who are never at that table.
Let me ask you something. My drive into town from the airport, on talk radio, they were saying openly that, well, there was a level of acceptance with this term that Ireland has lost their financial independence. And they're speaking about it in those terms as if, well, as you know, we've lost our financial independence. Isn't that the same thing as losing your independence?
It is exactly the same thing, because in today's terms, the economy and the financial structure of that economy, which underwrites it, is really what defines the sovereignty. Because we don't have army, we do not have wars, thank God, and we don't have physical conflicts over the borders. The only conflicts we have are competitiveness conflicts. And the competitiveness in the end is determined by things like infrastructure, institutional infrastructure, human capital that exists in the country, the productive capacity of the economy in its totality, the productivity of that economy. That is precisely what we talk about, the economic independence here, the ability to influence those dimensions, those components of economic, if you want, economic being that is the country itself.
They say that the Euro project was brought on to stop wars in Europe, but now with the Euro and the institutions that have come with this crisis, and the IMF and others coming in for foreign creditors, etc., there is, in fact, war going on. That hasn't stopped war. It facilitated a new kind of war.
There is. This week was very much clear point whereby the European political project has fully decoupled from the democratic project. We should be very careful, by the way, when we're talking about Europe. Europe has two components today. It has a very sick component, the so-called Eurozone, the common currency component, which is really a mistake, very deeply seated mistake, because it was never based on the premise of the democratic institutions of checks and balances. And as a result of that, it became anti-democratic, as we have seen this week. And Europe at large. Europe at large is very beneficent and very productive institution, if you want, because it is an institution of free trade, free mobility of people, free mobility of capital. This is exactly what we want. This is exactly what we need. We need more of it. And all of the economists today are saying that, economies outside of the Eurozone are saying exactly that. What we do not need is more integration, which is artificially grafted onto the foundations, which are so shaky democratically that the country cannot hold a referendum on something so fundamentally important, such as loss of its economic sovereignty, as we have seen in Greece.
Constantin Gurdiev, that's all the time we have. Thanks so much for being on the Kieser Report.
Anytime.
All right, that's going to do it for this edition of the Kieser Report from Kilkenomics in Kilkenny, Ireland. I want to thank my guest, Constantin Gurdiev. You can find him on the web. It should be easy because he's a rock star of economics. Till next time, this is Max Kaiser saying bye, y'all.